What's up, everybody? Michael Silva here. You're watching the Daily Stock Market Brief. Today's episode is the weekly recap. I'm going to keep today's weekly recap shorter than usual. The goal here in today's episode is really just to share some concerns that I see going on in the overall market, pair that in with some indicators. If you're new here, welcome to the channel. This is the Daily Stock Market Brief Show. I do it Monday through Friday, 5 days a week. We use technical analysis and intramarket analysis to help us get a good idea as to where the market might be headed next. Let's hop into today's show. All right, so first on the list, coming June 10th, we have the CPI data to release, and this is important information. The forecast is at 3.4%. It's going to be interesting to see what that actually comes in at. The last forecast was at 2.3%, and it came in at 3%. My guess is if we were to hit forecast or exceed it, we're going to start seeing a lot of news articles floating around about the highest rate of inflation seen in 27, 28, 30 years, most likely. Now, what I do find interesting about coming into June 10th to launch this CPI data, on May 12th, we had the last report. And if you just pull up a chart of the S&P 500, you can see that the days leading up to that, we did hit an all-time high. And then on the release of the CPI data, you can see here, it was actually falling. And then this big red candle was the date it was released and we headed lower. The PPI data came out shortly thereafter and we started to recover. But this is very similar to what's taking place right now. We're right back there at all-time highs going into the week where we have CPI data coming out. There are some charts that are a little bit concerning to me that makes me believe that we will potentially head lower here and then continue this rally. Overall, we're in very bullish context, and if we do continue to set new highs in the few days to come, then most of this is going to be irrelevant. So just keep that in the back of your mind. This is still very, very bullish context, and if you're on my Discord or if you follow on my Patreon, you would know that the only charts that I've been posting, the trade ideas, they're only from the long perspective because it's very hard to determine shorting, specific indices and specific stocks right now, just given the current context of the market. Now, June 10th is right here, this blue arrow. So the downside risk here is still right around that original target that I believe that we can come down to, and that's still right around 4,000. That is just right at the 100-day moving average and this previous resistance level right over here. So that is something that I'm looking for. Not too sure if it's going to be taking place, but we'll know here probably next week if we see continued strength and or some weakness come in. Another interesting thing is to call out the dollar. The dollar during that same time. Well, you can see here as the S&P rallied up during the days leading into the CPI report, the dollar was heading down into the CPI report. When the data was released, the dollar had a big up day. Meanwhile, the S&P 500 had a big down day. And you can see here very similarly, the dollar did break out of this falling wedge, which looked bullish. We said that it can quickly get reverted back. We don't know. It doesn't mean that it's going to shoot up to 93.5 in a day. This is mostly in a longer term consolidation. To really break down, we need to see it get a couple day closes below 89.50. But notice what the dollar's doing here. It was a pretty big red day. It's still positive on the year as the S&P 500 had a big up day. So the dollar was down, gold paired some losses, silver paired some losses. The S&P 500 almost made it to an all-time high. But like I said, we have the CPI data coming out here shortly. If it surprises very similar like it did in May, well, what's to say that the dollar is not going to just fall a little bit going into the report, but then see a big spike up there if we get a very similar reaction. On the weekly time frame, you can see it a little bit more clear. We do have, it's in a pretty nasty consolidation right here. It's not really going anywhere. We need to see it crack through these levels, and then that would suggest to me that we'll see commodities continue to press higher, and also potentially the equity markets as well. One thing that I do want to call out is the RSI. It looks like it's almost starting an early stage of kind of cupping around. That can be resolved very quickly, but that would mean to me that there could be strength coming in to the dollar. Not necessarily, my long-term view on the dollar is that it's going to be breaking down eventually at some point. As far as timing that, you can't really do that. Now, this chart is an important chart. This is something that I learned from a legendary technical analyst, Tim Ord, and he takes the ratio of the S&P 500 and the TLT, which the TLT is the 20-plus year Treasury bond ETF. So the ratio is down here. The S&P 500 is up here. And what you can look at is for divergences. When the S&P 500 makes a higher high, meanwhile, the ratio puts in a lower high, that is a little bit of a cause for concern. As you can see here, leading into the pandemic, you can see how the ratio was putting in a lower high, but the S&P 500 made a higher high. And you can see that happened a few other times. Right here, and then you can see the S&P 500 shortly then fell down. Now, what's interesting to me now is if the S&P 500 presses higher in these couple of days to come, that's going to be very interesting for this divergence that's currently building. That means if the ratio still remains at its current level or goes a little bit lower, but yet the S&P 500 continues to press a little bit higher, there'll be a clear divergence lasting for just about a month long. That's something that shouldn't be really scoffed at or just forgotten about. But in the shorter term time frame, it is currently diverged within the last, since the 17th. You can see here the S&P 500 has a peak high right here to a higher high. Meanwhile, right here on the 17th, the ratio has a high to a lower high, suggesting that it's very possible that this does head a little bit lower going into the CPI report. Is that for sure? Absolutely not. It's something just to consider, right? I'm just, like I said, I've been very bullish, cautious, just bullish, but cautiously bullish in this current environment. You don't want to fight the trend. You want to be a part of it, but you also want to make sure that you really take advantage of when you have profits to make sure that you put those profits in your pocket. Now, if you look at the TLT itself, you can see here, and even the TLH, it's been forming this bottoming pattern in overall very bearish context. But give credit to where credit's due, right? We have a low to a higher low and a higher low. We have an area of resistance right here at around 140 to 141. And overhead, we have the 100-day moving average. This last day, we did see a nice big uptick. Meanwhile, the 10-year yield we saw obviously drop. And the 10-year yield's been in this consolidation period very similarly to, obviously, the TLT. Now, if this starts breaking out, that would obviously suggest the yields continue to press lower. And what does that mean? Well, that means that we might continue to see a bid up in tech. Right? We've been seeing a lot of short squeezes in the market start to take place. Well, tech has been one of the underperformers really since early February. It's been going sideways, and we've had a lot of consolidation. So this would tell me that tech has the possibility to potentially push to an all-time high and come into this previous area of resistance, and that would be forming technically just. It would still be within that technical rising wedge pattern. If it doesn't reach that high, there's still the opportunity that this is a left shoulder head, right shoulder that is currently forming. So that's something also to watch out for. Meanwhile, the NI high low, this is something that we brought up a few days ago. We suggested that, is coming into this area, previous area support, but you don't want to get too excited until it crosses through the 20-period moving average. Well, guess what? It did, and we saw the NYSE press to an all-time high here. I did want to call out that it is still within this divergence. As you can see, this blue line right here, and it's coming into this. Now, it can easily get above that and get into this overextended territory, but just be mindful that this is still a divergence that's taking place in the market. As far as breadth goes, breadth wasn't really looking too good on Friday as the market really pressed higher, and you can see that on the short-term basis. It's not like a huge divergence, but a very short-term divergence taking place here in breadth. You can see the lower highs here on the NYMO. Meanwhile, the S&P 500 did press higher. And that's not the last divergence that I want to talk about that's still important. It's the one on the percent of stocks above the 50-day moving average. You can see if the S&P 500 presses higher here, there will be a very clear divergence in the percent of stocks above the 50-day moving average. What does that mean? Well, that means the market's making all-time highs. Meanwhile, it's doing so on less of the equities within the S&P 500. And that's also building there on the percent of stocks above the 200-day as well. And if you don't think that matters, well, think again. It has mattered in the past, as we've seen. Now, the sell signal, this is the CPC put to call ratio. We saw a decent spike up going on Friday. You can see it right around, where is that? Yeah, 0.84. But we like to look at the 10-period moving average, the black line, and when that crosses from underneath 0.8 but crosses up through 0.8, that is that sell signal. The last time that happened was right here, and it warned us quite well. I wasn't going to take this one too seriously just given the current market price action, but you did see it did roll itself over, and it has done so previous times too as well. When it crosses through, you can see some market action. Kind of just take a breath. It doesn't mean it's crashing, but it does mean that there's a possibility that you can consolidate or you can see it pull back slightly. Well, with this big spike in the CPC, it's going to take more work, and it has to hold up above these levels, above 0.8, to move the 10-day period moving average through that. But going into the trading week, so far it is looking like we're going to start seeing an uptick here, but it could take a week or 2 weeks to potentially even get that 10-period moving average through that sell signal. Another thing that I want to call out is the Dow Jones Industrials is very bullish. Everything looks very strong from a weekly perspective here. The only thing that it's a little bit of a concern to me is the price percent oscillator crossed over to bearish. So that means that momentum has been slowing. All right, we saw really like no volume at all this previous week too as well. So volume is just kind of dissipated. But what I do find interesting, and I want to get back to this, but actually, you know what? I'm gonna do that in the conclusion section. Let me stay on track here. The transports here now, the industrials and the transports, they do have to move hand in hand, right? They do work in hand. They actually had a down week, 1.8%, still an overall bullish context. But if you remember from previous videos, we were showing the quarterly charts, and the quarterly chart, the entire quarter was outside of the upper Bollinger Band. It just insane, just crazy distortions. The price percent oscillator here too is bearish. So if this divergence continues between industrials and transports, that to me is a little bit concerning for the industrials. Also to note, transports, you got to think, what is their biggest expense? It's oil, right? Transports, they're moving things around. Well, look at the price of oil. Oil is breaking out of a key level, 67.5. This to me looks like it can start screaming up to 75, 77.50 here very, very quickly. And that's going to apply more pressure. If oil gets more expensive, well, I mean, it hurts consumers. The transport, their expenses raise, which means products and things can get a lot more expensive to the everyday consumer, as well as these companies that make up the transports. Now, this is interesting to me because last year I was noticing the strong moves in oil. Typically, they precede stock market values dropping. Now, this isn't all the time, but it is something interesting. And I was looking at this chart, December 19th of 2020, as we were getting through this area, and to me, that looked like, it just seemed as if we can see a really quick rise in oil, and we are starting to see that pretty strong rise. This isn't an updated chart. This was from 2020, but as you can see, 70 is right here on the chart, and well, we are right here at 70 on the chart, suggesting that we can still get up 75, 70, 750 right there, which is, just right here at this red resistance line that we marked out a while ago. So I might be bringing this back a couple of times to just reiterate that. But you can see here, we see a pretty strong rally in oil, and then it dipped off. Strong rally in oil, and then it dipped off, and you can see the S&P 500 right beneath it. Strong rally in oil, then we had some chop. Strong rally in oil, we saw that drop, and now we're starting to see a pretty strong rally. It's too hard to time the top. It's very difficult to do something like that, and many people, they don't want to fight the trend or try to find the top. They want to just be part of the trend, and when things start turning, well, then they get out. They don't overcomplicate it. And when we look at a sector rotation model, this right here was developed by Sam Stovall, and what's interesting here is during the peak of a market cycle, the sectors that typically do the best is energy and materials. Okay, you can see here energy materials. The orange is the market cycle. The blue is the economic cycle. And as the market cycle starts to head down, you see consumer staples, healthcare, and utilities start to be the stronger performers. And that is typically at the peak of the economic cycle. Now, the last month of trading, Energy was the clear winner. Clearly, it was up almost 10%, almost double, right, the real estate. But if you look into this a little deeper and you look at the rotation of strength here, the relative rotation graph, you can see healthcare, consumer staples, and utilities have been improving for the last 5 weeks here in this specific chart. Now, I do want to call out that utilities and the XLP, they started to, they were more, going from bottom left to top right, going to leading, but now they're taking a little bit of a turn here, starting to head back down to the lagging section. Now, that doesn't mean that they're going to go there. That could mean that they just head this way and then go back. So it's still too early to tell, but it is something worth noting that, hey, energy, one, from an absolute perspective, has been doing extremely well. You can see here the 9%, but then also you can see energy is starting to weakening from a relative standpoint. Meanwhile, the three consumer staples, healthcare, and utilities have been improving. So something worth noting. You don't want to put too much weight on it on the short term, given the current context of the markets, but it is something that you want to just be aware of. The weekly time frame for the S&P 500, we did create a little bit of a hanging man candle. Hanging man candles are important to note, but they need confirmation to the downside. We're still still in this little channel on the weekly perspective. And if you look at the VXX right here, we're looking at the volatility. It's still within this falling wedge pattern too as well. We have a slight divergence. The market is very frothy, right? And you don't want to fight that. But to me, what this says is at any time, it could just be a very, very strong week, and it could shake a lot of weak hands, and then we could potentially resume its trend. So it's something that you just want to be very aware of and very cautious of. The same thing is going with the Qs. You can see here these tight consolidations of volatility, and we're pressing to the lower end of this channel. Meanwhile, the Qs are trying to break free to their all-time highs still here, and volatility is relatively high comparatively to where it was previously. It's just something to note. It's interesting. Typically, if you're an all-time high here, you'd want to see volatility lower, and it's a lot easier to be a winner in certain trading environments when volatility is just below this 20, especially on the VIX. It's a lot easier because the market's just kind of grinding higher slowly but surely. The IWM, very similar story here. We're at the bottom range of this trend line of the volatility, the RVX, and we're still within this technical pattern. It does seem like it wants to start breaking out and continue pressing higher, but it hasn't done so yet, and you don't want to speculate breakouts in this current environment. I mean, you can if you're very diligent with maintaining stop losses and so forth, but even if it breaks out, it still has some overhead resistance at the previous all-time high. The last chart I want to just go into is just a 15-minute chart, just to get a zoomed-in kind of view. We talked about this bull flag, and we said if it breaks out, we can reach that all-time high. Well, we almost did. Failed attempt. Now, what's important about this, and what I want to talk about earlier in the conclusion section, which we're basically there, is this. Think about Friday. We saw this gap up and this just relentless ramp up higher, almost to all-time highs. What is the market trying to tell us? The market is trying to tell us that they are very optimistic going into next week. They're okay with being long, right? Market participants are okay with being long heading into, a 2-day weekend where anything could potentially happen. This right here is telling me that sentiment is very bullish. However, it's something to just be a little, obviously, cautious about. Why is that the case? I just personally believe that this is the type of setups to just, mitigate the fear, and then potentially something then can happen. Now, is that always going to be the case? Absolutely not. But you don't want to turn a blind eye to something like this as we're pressing to all-time highs. Now, if the market continues to press higher and make an all-time high, most of this information kind of just becomes irrelevant very quickly. However, if the market presses higher, but the sectors are the defensive sectors leading the way, holding the market up in those all-time highs, that is a little bit of a cause for concern for me. And what do I mean by that? Well, coming into next week, if next week the top performers are utilities, consumer staples, or healthcare, those are more defensive plays. So that is something to watch out for. As far as my take on all of this going into next week, I'm remaining bullish. I'm remaining cautious. I'm looking for strong setups. I'm looking to play into some of these short squeezes that we've been seeing in the market. As I've stated, this video probably came off a little bit bearish, but it's really just concerns that everyone should be aware of and they should know of. You need to look at both the bullish perspective and the bearish perspective to really understand various dynamics. That's all I got for you on today's episode, everybody. Hope you have a wonderful day.